Hi everybody, and welcome back to video number 6 in chapter 20. And when we left off, we were looking to put into practice accounting for operating lease from the lessee and the lessor's perspective. The facts here are that consider the revised terms of a lease between Partner Shipping Company and Stroughton Trailers Incorporated for the right of use of a hydraulic lift. The lease, signed on January 1, 2025, specifies that Stroughton grants right of use of the lift to Parker under the following terms. 1. The lease agreement is non-cancelable with a term of 4 years requiring equal rental payments of $9,538.29, with the first payment on January 1, 2025, an annuity due basis. Number 2, the lift has a fair value at commencement of the lease of $40,000, an estimated economic life of 6 years. The lift has a residual value at the end of the lease of $8,000, which is unguaranteed. And the cost of the lift on Stroughton's books is $30,000. The lease contains no renewal options. The lift reverts to Stroughton at the termination of the lease. The implicit rate of Stroughton, the lessor, is 8%, and that is known by Parker. Stroughton determines FOE, fair use of fair rental payments, such that it earns a rate of 8% per year, the implicit rate, on its investment as shown in the following calculation. So the fair value of the lease equipment is $40,000. The present value of the residual value, $5,880.24. So the amount to be recovered by the lessor through lease payments is $34,119.76. So for beginning of year lease payments, earn an 8% return using the appropriate present value factor here of $9,538.39. All right, they want you to do several things here. Let's look at alpha first. Determine the classification of this lease arrangement for Parker, who is the lessee. So if I jump ahead here, the lease is classified as an operating lease by both Parker and Stroughton as indicated. The transfer of ownership does not occur. The asset reverts to Stroughton at the end of the lease. There's no bargain purchase option in the lease. The lease term is 66.67%. That's 4 years divided by 6 economic life years. And that is, which is less than the major part of the life asset, 75%. The present value test, the present value of the lease payments is $34,119.76, which is 85.3% of $40,000, the fair value of the lift. Therefore, it does not meet the present value test. And the alternative use test, as indicated, it's not of a specialized nature and is expected to have use to Stroughton when returned at the end of the lease. So, the lease is classified as an operating lease, as none of the classification tests are met to be classified as a finance lease. So for Bravo here, we're going to prepare the entry at inception of the lease for Parker, the lessee. So Parker's going to make the following entry. They'll debit right of use asset for $34,119.76 and credit lease liability for the same amount. Then they will debit lease liability for $9,538.39 and credit cash for that same amount. Now, under Charlie, prepare the lease amortization and lease expense schedule for Parker. So, here is that lease amortization schedule. And you'll see here our annual lease payments, the interest at 8%, the reduction of the lease liability, and the lease liability being amortized down to 0. Okay, I think that's pretty straightforward. We've done that calculation several times before. Now, from Parker's lease expense schedule, here are our lease expenses. Here are our interest on the liability and the amortization of the right-of-use asset and the carrying value of that right-of-use asset. Okay. So as indicated, the annual lease expense equals the interest related to amortizing its lease liability plus amortization of the right-of-use asset. Parker decreases the right-of-use asset's book value each year by an amount, a plug, such that the total annual lease expense is $9,538.39. So under Delta here, we're going to prepare the entries and show the financial statement presentation of the lease arrangement for Parker throughout the lease term. So if we look at Delta here we're going to recognize the lease expense and record amortization as of December 31, 2025 by debiting lease expense for $9,538.39 and credit right-of-use asset for $7,571.88 and credit lease liability of $1,966.51. And if we show our balance sheet, the non-current asset portion of the right-of-use asset is going to be $26,547.88. And our current liabilities section will have lease liability here for $9,538.39. And the non-current portion will be the balance, which is $17,009.49. Where lease expense on the income statement is going to be $9,538.39. So recording the second lease payment, we're going to do the same. We're going to do the same debit to lease liability and credit cash for $9,538.39. And then we're going to recognize the lease expense and record its amortization as of the end of the year 2026 by debiting lease expense and crediting right-of-use asset and lease liability, similar to what we just did. And our balance sheet will change slightly with non-current assets, current liabilities, and non-current liabilities. And our lease expense will be the same as 2025. Then finally, we will do a third lease payment here in 2027, debiting just like we did previously for 2026. We'll debit lease liability, credit cash for $9,538.39, and then we'll recognize amortization by debiting lease expense for $9,538.39 and credit right-of-use asset, this time for $8,831.86, and credit lease liability for $706.53. And we can get all those numbers from this lease amortization and lease expense schedules. Okay, and then finally, Echo, we're going to determine the classification of the lease for Stroughton Trailers, the lessor, and prepare the journal entries throughout the life of the lease. So for Echo, I forgot a portion of the Delta entry here. Here, we continue with part Delta continued, and here's our right-of-use assets, the current liabilities here, and then the lease expense here. We'll record our lease payments here as we normally did, and we'll recognize the amortization with those same numbers. So after the entry for final payment on December 31, 2028, the lease liability and right-of-use asset will be fully amortized. The lease expense for the 4 years is comprised of amortization of the right-of-use asset, plus the interest associated with the amortization here. So Parker combines interest on the liability and amortization of the right-of-use asset to report its lease expense on the income statement over the life of the lease. Now, as we go on to part Echo here, as shown on the evaluation of the classification test in part Alpha, Stroughton classifies the lease as an operating lease because none of the sales type lease criteria are met. Stroughton entry throughout the lease are presented as follows. So its lease payments for all 4 years will be a debit to cash and a credit to unearned revenue as the beginning of those years of $9,538.39. And then as it earns that revenue at the end of the year, it will reduce unearned revenue from leases for $9,538.39 and credit earned lease revenue for that same amount. And it will also record depreciation expense on a straight line basis by taking $30,000 and dividing it by 6, which gives us $5,000 for a debit to depreciation expense and a credit to accumulated depreciation on equipment. So under the operating method, Stroughton, the lessor, 1, continues to recognize the asset on its balance sheet. 2, recognizes equal amounts of rental revenue on a straight line basis in each period. And 3, depreciates the leased asset on a straight line basis over the asset's remaining economic life. Stroughton reports lease revenue separately from other revenues in its income statements or notes to its financial statements. A lessor should classify the leased equipment and accompanying accumulated depreciation separately from plant assets it owns as leased assets. Okay, as we change to a new section, we're going to discuss the accounting and reporting for special features of lease arrangements. And here we have 5 special accounting problems. 1, residual value. 2, other lease adjustments. 3, bargain purchase options. 4, short-term leases. And 5, presentation, disclosure, and analysis. That looks like a good place for us to stop this video. And when we return, we'll take a look at the residual values. Until that time, bye for now.